Silver is heading to $500 an ounce. Multiple analysts are confirming it. The technical structures are screaming it. But here is what nobody is telling you. The strategy you use over the next 90 days will determine whether you capture life-changing wealth or become one of the thousands who were right about silver and still lost money. Today, I am going to break down the 5 critical mistakes that will destroy silver investors before summer and the exact positioning strategy that the smart money is using right now while everyone else panics. Before we go any further, smash that like button right now. Drop a comment telling me how many ounces of silver you are holding today, and subscribe so you never miss a daily silver and gold update. Now let me show you why this matters more than you think. Here is what triggered this video. Silver is currently sitting around $78 an ounce after one of the most violent pullbacks in precious metals history. Just days ago, silver hit an all-time record high of $121.67 on January 29th. Gold is trading near $4,980 an ounce, knocking on the door of $5,000. And one of the most respected technical analysts in the world, Michael Oliver from Momentum Structural Analysis, the man who called the 1987 stock market crash, just went on record saying silver is heading to $300 to $500 an ounce by early summer. JP Morgan has come out with a gold target of $8,500. The bull case has never been stronger, and that is precisely why most investors are about to get this completely wrong. See, here is the problem nobody wants to talk about. In every single historic precious metal surge, the majority of retail investors who were correct about the direction still lost money. They bought at the wrong time. They sold too early. They panicked during the shakeouts. They held the wrong form of silver. And they had no strategy for what happens when the price goes parabolic. Let me walk you through exactly what is happening right now and why the next few weeks are the most critical window you will see in your lifetime. Let us start with mistake number 1. And this one just cost thousands of investors their entire position last week. Mistake number 1 is trading silver on leverage during a historic squeeze. Here is what just happened. The CME Group raised margin requirements on silver contracts, and the result was a cascading liquidation event that sent silver plunging from above $90, mid-70s, in less than 48 hours. Billions of dollars in leveraged positions were wiped out, and here is the part that should make your blood boil. The COMEX registered silver inventory has dropped from approximately 127 million ounces in early January to roughly 103 million ounces right now. Meanwhile, the March 2026 futures contract represents 429 million ounces of notional silver demand. That is more than 4 times the registered supply. In February alone, the delivery rate hit 98%. 98% of open interest stood for physical delivery. That is not a normal futures market. That is a physical allocation crisis. And the people who just got liquidated on margin calls were the ones who were right about silver going higher, but wrong about how to position for it. The leverage killed them. The smart money was not using leverage. They were accumulating physical metal. Remember that. Now, if you are watching this and thinking this is the information you have been looking for, hit that subscribe button and tap the bell, because I break down silver and gold news like this every single day, and the next 30 days could be the most important in precious metals history. Mistake number 2 is ignoring the Shanghai premium. Right now, silver in Shanghai is trading at a $30 premium over the Western spot price. Let me say that again. If silver is $78 in New York, it is effectively over $100 in Shanghai. Why does this matter to you? Because China has reclassified silver as a strategic material and restricted exports. They produce 80 to 90% of the world's solar cells, all of which require silver. And once silver enters China, it does not come back out. The global silver market is fragmenting right before our eyes. The price you see on your screen is not the real price of silver anymore. It is the Western paper price. The physical price in Asia, where actual demand lives, is significantly higher. Most investors are making buy and sell decisions based on a price that does not reflect reality. When this gap closes, and it will close violently to the upside in Western markets. Samsung just locked up 100% of a Mexican silver mine's output for 2 years through a direct prepayment deal. They did not go to COMEX. They did not buy paper silver. They went straight to the source and locked up physical supply. When the biggest tech companies on the planet are bypassing the entire futures market to secure silver directly from mines, that is telling you everything you need to know about where this is going. Mistake number 3, and this is the one that will haunt people for decades, selling during the shakeout. Michael Oliver addressed this directly. He said several prominent analysts publicly sold their entire silver positions around $90, bragging about taking profits. Oliver's response was devastating. He said these people are using old metrics from 1979 and 2010 and 2011. They are looking at indicators like RSI hitting 80 on a monthly chart and calling it overbought. But Oliver says the old norms of what overbought means are about to be shattered, just like the old $50 price ceiling was shattered. He compared this to copper. For decades, copper traded in a range of 50 cents to $1.50. When it broke out, it went to $4.50 in just a couple of quarters. Lee did the same thing in 2007. Gold has never been capped at its old highs. It kept making new highs decade after decade. Only silver was held at $50 for 50 years. That era is over. And the people who sold at 90 are going to face a brutal question. Do they get back in? And if they do they get in at a better price than where they sold? History says the answer is almost certainly no. The correction we just saw, Oliver called it the jiggle in the middle. He believes February will be an arm wrestling consolidation period, and by March we challenge the highs again. After that, his words, you go ballistic. Now here is what I need you to do right now. Drop a comment below with the word hold if you are holding your silver through this volatility. I want to see how many of you understand what is really happening here. And while you are at it, tell me your total stack in ounces. Let us see who has been paying attention. Mistake number 4 is not understanding the dual wave thesis. This is the part most silver content creators completely miss. Oliver describes silver as riding 2 waves simultaneously. The first wave is industrial. The supply deficit has persisted for 5 consecutive years. Solar demand alone consumed over 232 million ounces in 2024, and it is accelerating. Silver is critical for AI infrastructure, 5G technology, electric vehicles, and medical devices. And because silver is used in tiny amounts across millions of applications, it is almost never recycled. Once it is used, it is gone forever. But the second wave is the one that could take silver to truly historic levels. Silver is money. It has been money for 3,000 years. India is actively remonetizing silver. Central banks in emerging markets are adding silver to reserves. And here is the trigger. The US bond market is showing signs of structural stress. Oliver pointed out that bond futures are trading around 115, and if they drop to 112, his technical analysis says the holding pattern since the 2022 collapse breaks down. That could make the US start to look like Japan, which is already in crisis mode with its government bonds. If confidence in government bonds breaks, the monetary metals are the only refuge. Gold is 1 barrel in this scenario. Silver is double-barreled because it has both the monetary demand and the industrial demand pushing simultaneously. This is why Oliver sees 300 to 500 as not just possible but probable. Mistake number 5, and this is the strategy mistake that separates the people who change their lives from the people who watch it happen to someone else. Most investors have no plan for a parabolic move. They do not know at what levels they will take partial profits. They do not know what percentage of their stack they consider untouchable. They do not know whether they are holding for the monetary revaluation or trading the industrial squeeze. And because they have no plan, when silver hits 150 and pulls back to 120, they panic sell. Or when silver hits 200 and they have a 6-figure unrealized gain, the fear of losing it overwhelms the thesis that got them there. Here is what the smart money does. They separate their silver into two categories. The core monetary position that they are not selling regardless of price because they believe in the long-term monetary revaluation thesis, and the trading position where they have predetermined levels to take partial profits, not based on feelings but based on technical and structural milestones. Oliver said it himself, you want the doubt, you want the shakeouts, because in month 5 and 6 of the parabolic move, that is when the masses pile in saying, I have to be there. And that late money is what creates the blow off top. The people who held through the doubt are the ones who capture the full move. Now let me give you the timeline because this is critical. Oliver says the bell rang at the close of November 25. December was month 1. January was month 2. The massive correction hit at the end of January, a little sooner and deeper than expected, but it held key technical support levels perfectly. February is the consolidation month, the arm wrestling period. March is when we challenge the all-time highs again, and by early summer, potentially by June, the majority of the massive move to $300 to $500 should be complete. That means the window to position correctly is not next year. It is not next quarter. It is right now. The next 21 days are especially critical because February 27th is the first notice day for March COMEX deliveries. 429 million ounces of demand meeting roughly 100 million ounces of supply. If even 25% of those contracts stand for delivery, COMEX needs more silver than it has. This is the structural setup for the next leg higher, and it is happening in weeks, not months. Let me bring this full circle. Silver is going to $500. The technical analysis supports it. The supply and demand fundamentals confirm it. The monetary crisis building in bonds and fiat currencies demands it. But knowing where silver is going is only half the equation. The other half is your strategy. Do not trade silver on leverage during the most volatile precious metals market in history. Do not ignore the physical versus paper divergence that the Shanghai premium is screaming at you. Do not sell during the shakeouts designed to separate you from your position. Understand that silver is riding two waves, industrial and monetary, and both are accelerating simultaneously. And have a plan, a real written plan for how you will handle a parabolic move so that emotions do not override the thesis that got you here. Before you go, I need you to do 3 things right now. First, hit that like button because the algorithm pushes this video to more silver and gold investors when you do. Second, drop a comment with your silver stacking goal for 2026. Where do you want your stack to be by summer? And third, subscribe and hit the bell for daily silver and gold market updates because the next 90 days are going to be unlike anything this market has ever seen, and I will be here breaking it down for you every single day. The biggest transfer of wealth in a generation is unfolding right now. The question is not whether silver is going higher. The question is whether you will be positioned correctly when it gets there. I will see you in the next video.